The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Hello and welcome to Squawk Box. Here are your headlines today. The S&P 500 books back-to-back losses while mega-cap tech regains its footing as Wall Street grapples with a rocky start to September. Qualcomm launches a new PC processor, ramping up its challenge to Intel and AMD. CEO Cristiano Amon tells CNBC that the company is leading the way.
I think X Elite is now still the undisputed performance leader. He has breakthrough battery life, and we're just at the beginning. That's just the first wave of products for Qualcomm.
Burberry gets the boot. A quarterly reshuffle pushes the British luxury icon out of the FTSE 100 after 15 years on the exchange. And a change in the C-suite for Daimler Truck as it promotes Karin Rådström to replace CEO Martin Daum from October. We'll hear from the group's chairman, Joe Kaiser, at 10:15 CET. It's a data-heavy week already. We've seen strong reaction to the ISM manufacturing numbers. Now it's time for the data around the labour force. The first batch, US job openings fell to a 3.5-year low in July at just under 7.7 million versus expectations of 8.1 million, according to a Dow Jones survey. That's 237,000 down from June's downwardly revised figure and puts the ratio of job openings per available worker below 1.1. The data comes as the Fed's Beige Book survey found a growing number of locations where economic activity was flat or declining in the period running up to the 26th of August. Atlanta Fed President Raphael Bostic and San Francisco Fed Chief Mary Daly have both joined the chorus of Fed voices calling for a rate cut, highlighting the potential danger to employment levels if policy is held at current restrictive levels. But they both sounded a note of caution on the speed of loosening, with Bostic saying he is not quite prepared to declare victory over inflation, and Daly warning that price stability has not yet been restored. Well, let's just take a look at the market reaction yesterday. Somewhat tame, you've got to say, in terms of the swings a day prior. We saw large-scale losses on the NASDAQ, down 3.25%. So on the back of that, just a modest drop of 1/3%. Also in reverse for the S&P 500, dropping about 8 points or 0.1%. And the Dow claiming territory. So again, we talk about rotation. The Dow perched higher, up 38 points, or about 0.1%. So back in a positive pattern for the Dow at least, but not for the other major boards. That is the fourth negative session in the past 5 for the S&P 500. For the Treasury market, taking a look at some of the data, and don't forget it is going to get even sharper as we count down to the end of the week as we get narrow focus around the non-farm payrolls number. So far on the yield, we're 3.76%. On the back of the ISM, some market watchers keeping alive the prospect still of a 50 basis point rate reduction, although that is not the main scenario for markets. The data is still important to reinforce that view this week. In terms of the 10-year, 3.76. So the dollar has been a fade, and we've seen decline over the course of the week. Morning session, sterling on the front foot again, cable 131.5, almost just shy of that level. Euro dollar slipping a little bit morning session with 110.77. Dollar weaker versus the Japanese yen, sliding almost 0.2% and marking below the 143.5 level. Dollar on the back foot versus the yuan as well. So again, interest rate expectations key here as we weather the data this week. To WTI, Brent and gold. Speaking of weathering conditions, Brent and WTI have been facing a lot of headwinds of late. Despite the geopolitics, a lot of concern around the demand-supply story and just where there's still an appetite out of the Chinese market, one of the key typical companies seeking the demand from the market. But it's been a very, very small recovery that we've been watching in the Chinese market. And of course, we've been talking about more supply potentially this week as we watch the situation out of Libya. So Brent prices, WTI, both regrouping, pushing firm this morning, so picking up 1/3%, so recovering from some losses. Gold on the fairly flat, actually. What are we, just shy of 2,500 for bullion this morning? To the Asian markets, and in session. We are watching again another decline for the Japanese stock market. We witnessed that yesterday as Wall Street had a wobble, and again a lot of those technology names leading to the downside. We saw the Japanese stock market yesterday in reverse. Now, after a slight dip on Wall Street yesterday, we're still seeing fairly decent drop out of the Japanese stock market. So that is not abating, down 500 plus points in session. Outsized versus the Hong Kong market down 0.6, and even green splitting across to the Chinese and Australian markets. To US futures, let's just take a look and see what's in store for later on today. It seems as though there is a lot of caution still in this market, so we are chasing red arrows at this early hour. Again, the ranges are quite small, but it does tell you a story around the trend that we could be witnessing again as we count down to Friday's all-important jobs data. I mentioned that countdown. So payrolls report, so the non-farm payrolls report, and the moment we find out whether the Fed goes for a 25 or 50 basis point cut, these are the big moments for market. But it isn't only the data point we'll get before the week is out. Initial weekly jobless claims are expected to show a slight downtick to just under 230,000, while August ADP payrolls data is seen coming at 140,000. Joining us now is George Lagarius, who is chief economist at Forvis Mazars. Thank you so much for joining us, George. It is quite a week, isn't it? It was a big headline act from markets. Already we've had a strong reaction to the ISM. Jolts, a little bit of bump on the road here, but next up, of course, the big reports around the jobs market. What do you make of what we're hearing and the extent of a slowdown taking place in the United States?
Okay, so there is a slowdown taking place. That's no question about it, but I think we're very far from a recession. I understand there is a tick down in the jobs market. Some of it has to do, especially the unemployment rate, has to do with the increase in supply rather than a decrease in demand. Yes, job openings are weaker, but still we don't see, and manufacturing is weaker, but we were expecting the slowdown. Everybody was expecting the slowdown. There is just no evidence for a recession. And to that point, I don't think the Fed is going to move very aggressively.
Employment recruiters had been telling us for a while that, look, the labour market is cooling, but it's cooling in slow motion. Do you think that narrative has changed at all as we wade through some of this data?
No, and we don't have evidence to say the narrative has changed. However, we have to be cognizant that historically, what happens with unemployment is that it slows down slowly, and then it can slow down more aggressively. Okay, there is that historical pattern, but the data is just not there to tell us that the US is entering a more negative phase of economic growth. This thing was supposed to happen, but look, interest rates are coming down, inflation is coming down, the Chinese economy continues to deflate the world, so that's all good news for consumers. Why would consumption enter a recession? And you know, the US economy is mostly consumption.
If we can talk about that transition from simply taking down the hiring sign and moving towards an unemployment rate that ramps up, where you're actually seeing genuine job losses, that's a sort of economic scarring everybody gets concerned about if we head towards a recession. What are the tipping points for that type of scenario, and what sort of red flags do we look for in an economy?
I'll tell you the red flags I'm not looking at. It's your typical quantitative indicators like the SAM rule or the yield conversion, because sometimes these things work and sometimes they don't. Claudia Sam herself said, for example, I'm not trusting my own signal this time around. What would I be looking for? I would be looking for a massive slowdown in services, which we're not seeing. We're seeing a slowdown, but not a massive slowdown. I would be looking for a demand shock, or at least some very overt slowdown in consumption. And quite honestly, a lot of these are linked to an event. And I just haven't seen the event. Economies just don't go into recession for no reason.
If we consider the unemployment rate now 4.3%, it got there quite quickly, even though the SAM rule apparently doesn't apply this time around, according to even the author of that report. What do we make of its potential to rise aggressively from here without interest rate cuts?
Without interest rate cuts, it could be a problem. Although even if interest rate cuts happen today, they would take a year to go through the economy.
So that's what we're talking about, without interest rate cuts,
yes.
Because it is a Fed that could be behind the wheel in terms of helping out the labour market.
That is true, but unemployment rising. If tomorrow we get 3-4 new million workers just because of immigration, for example, it's an extreme example, but I'm driving to a point, then yes, unemployment would rise until all these people find work. And maybe there isn't demand for all these people yet. So, and that's sort of what we're seeing, an increase in supply of labor. But that will not tell you what will happen in the rest of the economy. And that is the point here. Unemployment itself is not the only economic indicator, and certainly not the indicator that it may have been historically.
The market, though, to be fair, is jumping at every indicator it's seeing. I mean, jumped at the ISM this week. It was jumping at the jobs data recently. It's been reactionary to the CPI numbers. So it's been reactionary to pretty much everything over the course of the last number of quarters. In terms of this Friday, it's the non-farm payrolls. What are your expectations, and how significant do you think that will be in terms of the final jigsaw puzzle this week on the labour market?
So the market was talking recession in August too, and everything was dropping, and the Nikkei was down 12%, and then 10 days later nothing happened, and 20 days later we're back at all-time highs with a broader market rally. You know, the market rallied ex Mag 7. And then again, 2nd of September and October are usually bad months. We are talking about a recession again. I think the market is moving for some cyclical reasons as well. And the narrative then comes to fill, and we say, okay, market is moving up, good news, market is moving down, recession. It works a little bit backwards this time around. As for the data, the employment data, I don't expect any robust reading. I do expect the reading to continue to be somewhat weak, but nowhere near the point where we're going towards a recession.
Well, the Fed wanted some weakening in the numbers, didn't it? It sort of saw the numbers as a bit too hot to handle in terms of getting inflation back to target. So we could be getting those numbers finally. When it comes to what the Fed does in September, there is a view that it'll be a 25 basis point rate reduction. Are you sure, are you guaranteed that this is going to be the extent of the reduction, or is 50 basis points also still a potential?
No one can guarantee what the Fed does. I don't think the Fed can guarantee itself what it's going to do. But I am firmly in the 25 camp. I don't see the urgency for the 50 cut. And the 50 cut might send a wrong message to markets and the economy, might send a message of urgency. And that could be a self-fulfilling prophecy. So it would be very dangerous if they went there without a specific reason. Unless you have an event, something that troubles markets, there is no reason for panic.
Which could have been the case if it had been an August type of scenario, but we're not seeing that.
Exactly.
Right now. George, thank you so much for joining us this morning. George Lagaria is with us, Chief Economist at Forvis Mazars. Our US colleagues will be speaking to ADP Chief Economist Neela Richardson later today. Don't miss that conversation. It is crossing at 14:15 CET. Ahead on the show, Qualcomm launches a new PC chip, with the CEO Cristiano Amon telling CNBC the company is looking for a boost to the traditional computer. We'll bring you that exclusive interview right after the break. Plus, it's a bye-bye for Burberry as the stock gets demoted from the FTSE 100 index for the first time in 15 years. We'll break down how we got here later this hour. And earnings season continues here on CNBC. We'll be speaking to the CEO of Enquest as the company releases its half-yearly results, so that is at 8:30 CET. Nvidia has rejected reports that it's been subpoenaed by the Department of Justice over antitrust concerns, with a spokesperson telling CNBC it has reached out to the DOJ to clarify the situation. Bloomberg had earlier reported the story, sending shares lower in extended trade Tuesday, but did not clarify why the regulator was examining the chip giant. The spokesperson told CNBC Nvidia is happy to answer any questions regulators may have about our business. For more on those Nvidia comments to CNBC, you can head to our website, cnbc.com, for the full story. Qualcomm has unveiled a new PC processor as the US chipmaker looks to ramp up its push into the AI personal computer space. Arjun is here with more. Arjun, we spoke to Cristiano Amon earlier in the year, and he was telling us that the future was AI on device. What have you heard now from him in terms of where this is progressing?
Well, we know Qualcomm to be a leading player in terms of smartphone processors as well, but last year they launched this Snapdragon X series of PC processors specifically for what you are saying there, on-device AI on the PC as well. And the big deal really happened this year when Microsoft launched a series of Surface products which had Qualcomm chips in them ahead of Intel and AMD, and that really gave Qualcomm a shot in the arm. And since then it's been very aggressive on new launches, and yesterday it launched a Snapdragon X Plus 8-core. Bit of a mouthful, but that's the name of the latest chip. And this is actually designed for PCs that go as low as $700. So they're trying to address a larger market at this point and really ramping up that competition in the PC space with Intel with a focus on on-device AI. So I had a chance to catch up with Cristiano Amon, the CEO of Qualcomm, and asked why now for this AI PC push. Let's just listen in.
It was a logical thing for us to do, and also it's a logical thing also for Microsoft with their partnership with Microsoft. If you look what we did, it was a number of things coming together. First, I think our company has been on a diversification journey. I think every time you and I talk, we kind of provide updates about how we enter new industries. It was automotive, now it's PCs. So we are on a journey to diversify and make sure our technology is now expanding to other markets. The second data point is PCs are fundamentally changing because of two drivers. One driver is mobile PC conversions. We use our mobile devices, they're inseparable devices, and a lot of the technology is influencing what do we expect our PCs. We expect to be connected, we expect long battery life, we expect them to be thin and light, and that is also coming at a time that the Windows is transforming to AI with Copilot plus PCs. When you put all of those three ingredients together, that's where Microsoft and Qualcomm join forces for us to bring Snapdragon to PCs. And what the X series did, it restored the performance leadership now to the Windows ecosystem. Some of the fastest laptops in the world are now running Windows Copilot plus PCs with Snapdragon X Elite.
And talk to me about that product roadmap in the PC space then, Cristiano. You've been very quick and aggressive in launching these new processors. This latest one with the Core 8, looking at those PCs as low as $700. Can we expect this year or when can we expect the next product that perhaps looks to hit more of a mass market kind of price point?
Yes, look, I'm going to walk you through the sequence. Like the first thing we did with X Elite when Copilot Plus was announced was our job was to restore the performance leadership back to the Windows ecosystem, have the performance leader. Then after that, we announced the X Plus. Today's announcement, it's about now bringing AI PCs to mainstream. Just think about it. A typical laptop that an enterprise or a commercial customer buy is in the $900 range, and it's not an AI PC. Now you can have not only $900, but also $800 or even $700 range, and you get a performance leader with an AI processing engine for AI PC with Copilot Plus. So we see that's a great opportunity to expand your addressable market and bring scale. Next, you're going to see mini desktops from Qualcomm as well, and we're going to continue to add products to the roadmap, eventually to have the full range of PC products so we can participate in the total addressable market in this space.
So that was the Qualcomm CEO there saying there are more PC processors coming, perhaps at different price points for different models, and therefore trying to expand the market in processors. And really there are some converging themes Cristiano Amon was addressing there as to why they're jumping into this. First, the boom of generative AI that we've seen, and the desire for these AI processes to happen on the device rather than up in the cloud. And also the fact that these chips are actually built on an ARM architecture, which is allowing the company to get low power consumption, which is really what these device makers are looking for as they are carrying out these really high-powered AI processes on device. Of course, competition is rife here. A day before Qualcomm announced this, Intel came out with their response to Qualcomm's latest chips. They've been accused for a long time of being behind the market at this point as well. But if Qualcomm can crack this PC market, it will help push diversification for this business beyond smartphones.
I want to bring up the competition. I mean, there's no doubt that Intel has had a woeful year. If you look at the stock price performance, the series of news flow, I mean, even overnight, news about the contract manufacturing business failing tests with the chipmaker Broadcom. So it's sort of death by 1,000 cuts that we're seeing over the course of 2024. What do you make of how Qualcomm is positioning around Intel's flaws at this stage?
The timing is obviously fascinating. It's coming at a time, as you mentioned, when Intel is facing a ton of trouble. And one of the, I guess, bright spots for Intel to some extent is the fact that they still remain the dominant player in the PC market. But the question is this legacy, and can Intel continue to innovate to remain ahead of the competition? Now, Qualcomm, of course, has a ton of experience in the smartphone space. Now, when you think about what's happening with PCs at this point of time, they are converging and becoming a lot closer to the smartphone experience with apps and the way people interact with them, touchscreen, etc., etc. So Qualcomm, I think, knows that it's got a strength in smartphone. It's trying to convert that over to PC. Intel missed the smartphone boom. And so what I think the challenge for Intel is going to be is to come out with these chips and show that they're able to bring out semiconductors that are able to do these complicated AI processes that device makers want to put on the device, again with low power and in a competitive way to what Qualcomm's bringing out at the moment.
AI is such a huge reset moment for the industry. For those that have been underperforming, those that have been outperforming, has big consequences. I want to just ask you about the view that Amon had when it came to the stock market. I mean, we've seen a lot of questions around Nvidia just in recent days. It's been a leader, it's lacked leadership now. Does he think there's some froth? Does he see a bubble around some of these names?
Well, we'll bring you some of his comments in the next hour, but just to tease some of those, his thoughts were, look, we as Qualcomm are playing in a very different part of the market to Nvidia. Nvidia chips are designed for the data center, for training these huge models that the so-called hyperscalers like Amazon and Google, etc., are pushing out via cloud. We are focused on devices and processing artificial intelligence on devices. This is an area that's booming. This is an area that all the device makers want to get into. And so that's where he's trying to position Qualcomm as different to Nvidia. Whether the market believes it, when we see some of those moves like the other day, Nvidia falls, Qualcomm falls, the whole chip sector falls, that's a different story.
Yeah, I think in technical terms we call it the edge, don't we? So let's see whether you could be protected in the periphery at the edge from the center, the data center. Arjun, thank you. And for plenty more on Arjun's exclusive interview with the Qualcomm CEO, you can check out CNBC.com. Google is facing another antitrust trial next week. The US Department of Justice is seeking to break up the tech giant's digital advertising business, which it argues is unfairly harming competition. Google denies the claims and argues that a breakup could slow innovation in the tech space. Google lost a similar case in August when a judge ruled that the tech giant illegally monopolized online search. Our colleague Deirdre Boss filed this report.
Shares of Alphabet are under pressure as the antitrust scrutiny ramps up. Today, we get a joint filing from Google and the Department of Justice outlining their timeline for remedies. On Monday, another Department of Justice trial, this one focusing on ad tech, that will get underway. Wall Street, meanwhile, is already trying to game the possibilities of the first lawsuit of which Google has lost. Bernstein outlines 4 structural remedy scenarios. 1, the elimination of exclusionary contracts. That could kill or hinder the billion-dollar exclusive agreements between Apple and other Android device manufacturers, potentially hurting them as much as that could hurt Google itself. 2, the judge could force open Google's walled garden by compelling the company to license their technology to third parties. And that could potentially have big implications in the AI race. Competitors like SearchGPT and Perplexity could gain access to Google's library. The 3rd, asset divestment, aka a breakup. As we've discussed, that's seen as unlikely and technically difficult. The 4th, some kind of consent decree that would limit exclusionary deals with Apple and other device makers and focus on limiting Google's monopoly in generative AI search. Now, it could take months or even years for any scenario to come to fruition, but the growing fear from Wall Street and that is now certainly impacting the stock, is that even the threat of these remedy scenarios could materially hurt Google's ability to compete and divert time and resources. This also comes at a critical moment when Google is figuring out how to keep its dominance in the age of AI, when there's more competition than ever. On Monday, the street will have to consider another lawsuit and eventually consequences to that one, this time targeting Google's ad tech. Advertising, of course, is Google's bread and butter, contributing to more than 75% of Google's more than $300 billion in revenue last year. Investors are expecting a decision here in 2025, and the possibility that Google may have to go to the negotiating table around a broader package that addresses the DOJ's concerns across both lawsuits.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.